Hi. Welcome to Finance, Business and Investing. I watched and read every publicly available piece of information in order to bring you the most important investment advice from the world's greatest investor. In 2017, 4 different takeaways from Warren Buffett stood out the most to me. Warren Buffett has spoken about the importance of having a circle of competence and how to create one, explained how interest rates should affect the price you are willing to pay for stocks, and chastised managers for the way they use share repurchases. And, while this was not said by Buffett, Bill Gates did present how Buffett taught him about time management in an interview in which both of them participated, and I believe that this is a great little tip from which you can benefit. Warren Buffett has frequently been quoted discussing what he refers to as a circle of competence. The concept is straightforward. Purchasing a stock is equivalent to betting on a company's future. Of course, the future is always unpredictable, and anything can happen. As a result, we as investors must learn to think in terms of probabilities in industries and companies where the future is at least less hazy than elsewhere. This is your first circle of competence, where you can place your high probability bets. It's critical to consider where you might have such superior knowledge. According to Warren Buffett, having a large circle of competence is important, but knowing where its boundaries are even more so. You can make a lot of money in the stock market if you only know about 5% of the companies in your circle of competence. Consider the following. What products or services do you use on a regular basis? What subjects did you study in school? What city are you in? Do you have any specific local knowledge about the industry in which you work? For example, I consume a lot of Pepsi Max Lime. I understand the type of value this brings me. I'm fairly certain about my price sensitivity to Pepsi. You can probably charge me more, and I'm familiar with the company's competitors. I studied industrial engineering and management at university, so I may have some knowledge of industrial companies such as Boeing, Lockheed Martin, and Volvo. Furthermore, I am Swedish, so I should know a little bit more about Swedish companies than the average person. I've grown up hearing about these companies, and finally, working in social media and finance may give me an advantage in that field. I encourage you to post the video here to consider your own circle of competence. That being said, in the stock market, it is critical to remain opportunistic. Some industries underperform for decades. So, if you rely on yourself too much, you risk becoming stuck in a situation where there are no opportunities available. You should always strive to broaden your circle of competence. Furthermore, you are not limited to specific industries or countries. If you look at this table of Warren Buffett's 25 most important investments, you'll notice that, with the exception of insurance, there is virtually no overlap between industries. This is because, first and foremost, Buffett has a large circle of competence that he has built over many decades, but also because he has chosen to focus on a specific type of company situation. In addition to avoiding certain industries and sectors, the companies in which Buffett invests frequently meet the 5 criteria listed below. I'll pause here for a moment before moving on. Investing in the stock market is all about weighing opportunity cost. Committing your money to the stock market means that money won't be available for rental properties, bonds, or instant gratification. The trick is determining when the stock market is superior to other options. Warren Buffett believes that the 10-year U.S. Treasury note is the ultimate yardstick for this. Government bonds, and their yields, typically track interest rates. The stock market is governed by interest rates. Stock prices and interest rates have an inverse relationship, which means that when interest rates are low, stocks become more expensive, while when interest rates are high, stocks become cheaper. However, speaking in terms of expensive or cheap is somewhat misleading, as only the relationship between interest rates and stock market prices determines this. To comprehend, perhaps this analogy will be useful. Even if you don't frequent the gym, you could probably deadlift 500 kilograms like Eddie Hall. If you were on the moon, the weights would only be considered heavy or light when gravity is taken into account, just as gravity works on that barbell. Interest rates have an impact on stocks, and stocks are currently at an all-time high. The P/E ratio is another popular metric for determining whether stocks are expensive or cheap. The S&P 500 has an average P/E ratio of 36.2. At this time. Now we know that simply looking at this number and determining that it is historically high is insufficient to conclude that the stock market is expensive. No. We must also consider where interest rates are, preferably the 10-year U.S. Treasury note. As previously stated, a governmental bond's P/E expresses how much you pay for every dollar of yearly earnings P. E of 20 indicates that you pay $20 per year for $1 of earnings. To make comparing stocks and bonds easier, we could use a similar metric, called the earnings yield of a stock with a PE, which is the exact inverse of the PE. Has a 5% earnings yield out of 20. Every year, you will earn $1 on your $20 investment, or 5% on your invested capital. Take a look at this chart, which shows the S&P's average 5-year earnings yield. And P 500. It is also compared to the 10-year U.S. Treasury rate. A better way to determine whether stocks are expensive or inexpensive is to compare them. Stocks are said to be cheaper when their earnings yield exceeds the yield on these 10-year bonds. When asked if stocks are expensive or cheap at current prices, we may reach a conclusion. The opportunity cost of being in stocks is very low right now, at least when compared to U.S. governmental bonds, which have earned nothing. In fact, the disparity between stocks and bonds has only been dislodged 5 times in the last 50 years. So here's the final word. Stocks are currently inexpensive if interest rates can remain at their current levels for an extended period of time. Companies frequently repurchase their own stock. It is a tax-efficient method of distributing money to shareholders for a number of reasons. It shows that management believes in the company's prospects and keeps the stock in demand. Warren Buffett believes that share repurchases are overdone. In fact, he believes that most managers are doing a disservice to their own shareholders by doing so because they rarely consider the most important factor when purchasing shares. It must be done at reasonable prices. From the perspective of exiting shareholders, I'll quote Buffett from his 2017 annual shareholder letter. Repurchases are always beneficial, though the daily impact of these purchases is usually negligible. For continuing shareholders, it is always preferable for a seller to have an additional buyer in the market. However, repurchases only make sense if the shares are purchased at a price lower than their intrinsic value. According to Buffett, the question of whether a repurchase action is value-enhancing or value-destroying for continuing shareholders is entirely dependent on the purchase price. As a result, it is perplexing that corporate repurchase announcements almost never mention a price above which repurchases will be skewed. Consider how much McDonald's has spent over the last 15 years repurchasing its own shares by launching new share repurchasing programs every third year or so. In each of these years, the company has repurchased shares. Now comes the million-dollar question. For the past 15 years, McDonald's has been undervalued. I seriously doubt it. Nonetheless, the company's executives have been behaving in this manner. I should point out that McDonald's is far from alone in this regard, and they have been buying back shares in varying amounts every year. Buffett, as usual, consumes his own creations. That is why Berkshire exists. This is how Hathaway's repurchases appear. Buffett rule, which stated that Berkshire will only buy back shares at 120% or less of their book value, was buffeted in 2017. In these cases, Buffett determines whether or not continuing shareholders are getting their money's worth. I'd like to conclude with a quick tip on time management. Bill Gates and Warren Buffett are great friends who have influenced each other greatly. When they first met, Gates' schedule was always jam-packed with meetings, travel plans, and so on, as you'd expect from the founder of one of the world's most valuable companies. But then he met Warren Buffett, who ran a similar-sized company with only a few appointments per week. Buffett's strategy was quickly adopted by Gates. Warren Buffett is an expert at saying no and believes that staying active all the time is not a good predictor of success. He believes that simply sitting down and thinking is undervalued, whether you want to be a successful entrepreneur or a stock market genius. This is critical. Prioritizing can greatly aid execution, especially once the snowball has begun to roll. Hi. Welcome to Finance, Business and Investing. Now for his advice over 2018. This year, the world's greatest investor won a 10-year bet, proving that most Wall Streeters do not deserve their high salaries. He also explained what investment risk is, which I will use to guide you through your first home purchase, and provided his ultimate checklist for which stocks you should buy for your portfolio. Warren Buffett has frequently stated that investing in a low-cost index fund is the best way for a passive investor to reap the benefits of the stock market, putting his money where his mouth is. He made the following wager. Over a 10-year period beginning January 1, 2008 and ending December 31, 2017, the S&P 500 will outperform a portfolio of hedge fund funds when performance is measured net of fees, costs, and expenses. Despite the fact that many active managers on Wall Street are eager to tell potential clients how their funds will almost certainly outperform the S&P. Ironically, for a long time, Buffett could only hear silence. No one wanted to take this bet because it involved their own money. This, I believe, was probably enough to determine who would win, but then a firm called Protégé Partners stepped up, specializing in identifying seeding and early-stage investing in investment funds. It chose 5 funds of funds that invest in hedge funds, and Buffett chose a low-cost S&P 500 index fund sold by Vanguard. Each put up $320,000, which would be worth $1 million by the end of 2017 and would be invested in the winner's choice of charity props as a reward for taking this bet when no one else would. But I'm not sure if they expected to win or if it was just a publicity stunt. These were the final results of the bet, which Buffett presented in his annual shareholder letter for 2018. These are truly astounding results. After fees, costs, and expenses, the 5 funds averaged a 3% annual return, while the Vanguard Index Fund returned 8.5%. As a result, they underperformed by about 5.5% per year. The most astonishing result, in my opinion, is that none of the funds were able to outperform the index fund. This is absolutely hilarious. It demonstrates 2 things, in my opinion. It demonstrates that, as Buffett says, fees never lag behind performance. It also demonstrates that the majority of active Wall Street executives do not deserve their high salaries. They're just joking. Another quote from Buffett: "Uninformed customers with smart marketing. When a person with money meets a person with experience, the person with experience takes the money and the person with money takes the experience." Forget about the alphas, betas, gammas, and other insider jargon that Wall Street's priesthood likes to use to scare you away from managing your own money. That has never been the case with investment risk. And, in Berkshire Hathaway's 2018 annual letter to shareholders, Warren Buffett expresses the correct meaning. Investing is a foregone consumption today, in order to allow for greater consumption at a later date. The possibility that this goal will not be met is referred to as risk. Let us apply this definition of risk to the million-dollar question. In X years, you will purchase your first home. Should you invest in stocks, B invest in bonds, or C keep the cash? The solution will be beneficial for any large-scale purchase. It also applies if you're saving for a nice car, a boat, or an upgrade to your current home. So we have 3 options. We can invest in stocks, bonds, or keep our savings in US dollars. To begin, keeping your savings in US dollars is not a good idea. Because the Fed has promised 2% inflation each year, it is almost certain that your money will buy something less valuable in the future. The only way this will not happen is if housing prices collapse, which is possible. However, because we are discussing cash outlays in general, we will assume that the price of the asset you want to buy with your savings moves with inflation when deciding whether to invest in stocks or bonds. Let us conclude that stocks have outperformed bonds in terms of returns over the last century. So, when stocks do not lose money, they are usually a better investment than bonds. That's out of the way. Depending on your time horizon, here is the investment risk of investing in stocks. I'll also include the average returns you would have received based on those horizons here. Here are a few highlights. If you were to make a large cash outlay in 1 year, your money would be worth less in 33% of the cases if you invested in the stock market. On the other hand, you could get something 8.4% fancier on average. With a 5-year time horizon, your money would be worth less in 25% of the cases. However, on average, you will get something 47% nicer after 10 years, and 12% of the time you will be worse off. However, you will typically receive something more than twice as large, fancy, or good. And for periods of 18 years or more. Since 1928, there hasn't been a single instance of a stock market decline. You also get something 4 times as nice sweet. This chart will not make investment decisions for you, but I hope it will serve as a guide if you anticipate any large cash outlays in the future. It also emphasizes an important point. A diversified portfolio of U.S. equities becomes less risky as an investor's investment horizon lengthens. Since there is no way to predict market movements, here are Buffett's thoughts on investment risk in relation to Berkshire Hathaway. I recommend buying Berkshire shares only if you intend to keep them for at least 5 years. Those looking for quick profits should look elsewhere. Investing in index funds is an excellent 80-20th strategy for managing your own money. You'll reap many of the benefits of investing without having to devote any of your time to it. But I know that many of you are looking for more. An 8.4% average return is insufficient for you. You want to achieve financial independence as soon as possible. If you want to be the next Warren Buffett, here's the best summary I've seen so far on which individual companies and stocks Warren Buffett himself invests in. Buffett is looking for a company with long-term competitive advantages, capable and high-quality management, and good returns on net tangible assets required to operate. The company, opportunities for internal growth at attractive returns, and a reasonable price would take too much time to explain in this single video. As a result, I'll include a watching list in the description of this video so you can delve deeper into them yourself. However, I will say that visualizing individual stocks and companies for yourself could be beneficial. You could, for example, use these 5 key characteristics to rate a company you're interested in on a 0 to 5 scale for each of them. You'll force yourself to conduct the research necessary to be a successful active investor. Furthermore, you will be forced to use an investment framework with a proven track record. After all, the man who invented it became the richest man in the world by using it. Now, in 2019, he had these words of wisdom. As Buffett has demonstrated, there are 3 situations in which debt should be used for investment. We were told that you had never invested in an IPO. Although Buffett has frequently stated that debt is a 4-letter word at Berkshire Hathaway, he has used it in a few instances throughout his investing career. First and foremost, let us discuss why leverage is typically a risky instrument to use in your portfolio. It's because, while using debt to boost equity returns is usually a good idea, it can be disastrous at times. Consider the S&P 500's performance over the last 40 years. When considering this, you may be tempted to leverage your portfolio by using 50% of your own capital and 50% borrowed capital. As a result, purchasing the S appears to provide 100% greater returns during this period. P500. However, there is a minor issue. The market dropped by more than 50% during the financial crisis, which means your account could have been completely wiped out. Even in elementary school, we were taught that no matter how large a number, times 0 equals 0. In reality, your broker is unlikely to allow this to happen. But let's say you suffer such massive losses that you never want to invest again. Using too much debt is akin to playing Russian roulette. Sure, you'll win most of the time, but every now and then you'll blow your brains out. According to Buffett, rational people do not risk what they need for what they don't have and don't need. However, there are a few instances in which Buffett has used that in the past. For example, he likes to defer taxes as much as possible, both on investment gains and at the corporate level. Using debt in this way. Although this varies depending on where you live, it is risk-free because you only pay taxes on profits and thus cannot go bankrupt doing it. Furthermore, the interest paid on this debt is either 0 or extremely low. 2. Buffett invests in the insurance business of Berkshire Hathaway by using the income from premiums known as float. If the insurance industry is competitive, this debt not only comes with no interest, but you can be paid to keep the money if premiums exceed claims over time. 3. And he sometimes borrows a lot in subsidiary companies. A parent company is not usually legally obligated to repay a subsidiary's debt holders. To the extent that you can, using debt in this manner is similar to taking leverage bets with a limited downside. It may be useful to consider how you can use these 3 types of debt in your own portfolio and perhaps later in your investing career as well. This is one of Buffett's most famous quotes: "Be fearful when others are greedy, and greedy when others are fearful." How could this be, given the thousands of investment opportunities available on any given day in the stock market? The one with the most advertising would be the best one to invest in. The answer is that it is almost certainly not possible. There are at least 2 major issues with investing in an IPO. In the long run. First, it's an opportunity for the company's insiders and founders to sell, and I can almost guarantee that when the people who know the company the best are selling their shares, you're not getting them cheap. Second, an underwriter is heavily promoting the company. An investment bank that is often incentivized to sell as many shares as possible at the highest possible price. A successful IPO for the underwriter often results in bonuses being paid out, as well as more business in the future. Combine these 2 factors and you'll realize that, on average, and for the long-term investor, IPOs should be avoided. Buffett consumes his own cooking. By the way, I'm not sure if he's ever taken part in an IPO. At least none of his more significant transactions were IPOs. Please let me know if you know of any exceptions in the comment section. And, no, I don't believe Berkshire's recent investment in Snowflake counts because it was most likely made by Todd Combs, who oversees a much smaller portfolio at Berkshire than Buffett. Buffett values autonomy and delegation of responsibility. In his 2018 annual shareholder letter, Buffett stated the following: "Each of us manages more than $12 billion on our own." In order to answer whether Berkshire is departing from its traditional value investing approach by purchasing shares, I usually look at monthly portfolio summaries. For example, Amazon Buffett stated that all investing is value investing. You buy something today with the expectation that it will yield more for you tomorrow. Forget about dividend investing, growth investing, dividend growth investing, or whatever is popular. There are a variety of reasons to invest right now. Sometimes it's because the company is expected to be able to distribute earnings efficiently. Sometimes it's because it has exceptional growth prospects, and sometimes it's simply because it has a lot of valuable assets. Regardless of where this value comes from, you'll only be profitable if you buy these prospects at a reasonable price. What you pay will always determine whether or not you made a successful investment. Even candies are seen. And the Geico companies that have returned billions of dollars to Buffett may have been overpriced when he bought them. As a result, all investing is value investing. Warren Buffett, Charlie Munger, and Bill Gates all attended a once-in-a-lifetime CNBC interview at the same time. Damn, that's nearly 0.16% of America's total wealth gathered for the same interview. Anyway, they were talking about how historically low interest rates are right now and how this might affect the stock market. Bill Gates stated, "I am astounded at how high the valuations are." If you look broadly, Charlie Munger believes that you can't print money to solve all problems and will eventually end up with something akin to Venezuela. Although he does not believe this will happen anytime soon. Warren Buffett stated, "I could not have imagined a world with almost full employment, a 5% budget deficit, and a 30-year government bond yielding 3%. By the way, Buffett claims that he would have said the same thing a few years ago, and that if he finds something impossible, it usually doesn't last long. I watched and read all publicly available material to bring you Warren Buffett's most important investment advice for 2020. This year, the world's greatest investor delivered an important reminder about how to behave during times of turmoil, discussed cash and its role in the stock market portfolio in his usual manner, delivered burns to Wall Streeters, and explained something that everyone should do before even considering investing in the stock market. By the way, the Berkshire annual shareholder meeting looked a little sad this year because Buffett was missing his partner in crime, Charlie Munger. As a result, it looked like this year, whereas it usually looks like this. Let's start with the first one because of the current pandemic. I think it's a good thing to be reminded of the wisdom of Buffett. He claims that in today's markets, there is so much we don't and can't know. We do not know when this pandemic will end. We don't know what impact it will have on the economy, and we certainly don't know how it will affect the 2020 presidential elections. But, as long-term investors, none of this matters because we know that the stock market will continue to outperform other types of investments. It will outperform that 0.8% 10-year U.S. governmental bond, gold and cryptocurrencies, the money under your mattress, and so on. Speaking about the entrepreneurial drive of its people, Buffett said never bet against America. Of course, this statement could be modified for a variety of other countries. To get to the point, we've been in worse situations before and done just fine. In fact, if you just bought the market in general, the Dow Jones Industrial Average, when you graduated from college, you would have done better than fine. If you did this when buffets were young, you'd be 100 times richer today. How's that for a retirement? Remember that the stock market has survived worse situations in the past. Consider a world war in 1939 that killed 85 million people, or 3% of the population at the time, or the threat of a far more dangerous disaster in 1962. Or how about a major meltdown in the financial system in 2008? Human ingenuity won't be stopped by corona and therefore the stock market won't be stopped either. Warren Buffett has always stated that the stock market is a tool for transferring money from the impatient to the patient, and 2020 is no exception. Buffett is not abandoning stocks. Just look at the top 15 largest public holdings that Berkshire Hathaway owned on 1 January 2020 and its largest holdings. More than 10 months later, Buffett has sold for a total of $28 billion of the market value on January 1. While this may seem like a lot of money, keep in mind that Berkshire Hathaway is a behemoth with a current value of around $500 billion. That profit has sold a total of 5% of the value of his holdings since 2020 began, in my opinion, is nothing to be concerned about. This brings us to another important takeaway for us. Buffett's cash position at Berkshire Hathaway is currently at an all-time high of $143 billion, as discussed by Buffett during 2020. Look at this graph, which shows cash and cash equivalents as a percentage of Berkshire's market cap. It's currently around 28%, which is the highest. It's been that way since the beginning of 2006. What does this mean for you and me and for our stock market investments? First and foremost, we must consider why Buffett would hold such a large cash position. It's really quite simple. It's because he hasn't found a worthwhile use for his money. Buffett is no longer concerned with macroeconomic data. For example, he would not go to multiple.com and conclude that the pay of the S&P 500 is high compared to historical numbers and then say either invest or don't invest, because Warren Buffett understands that even if the stock market as a whole is expensive, there may still be some gems out there. So if Buffett has a large cash position, it means he hasn't found any of these gems, which could be interpreted as a sign that the market is overvalued. Before you sell off parts of your own portfolio and establish a cash position similar to Buffett's already in 2008 when Berkshire was less than half as large as it is today, Buffett said that he and Charlie Munger are looking for companies with a market cap of $10 billion or higher, which excludes more than 90% of all listed equities. In other words, while Buffett cannot currently find any gems among the 10% that he is looking at, you and I may still find exceptional companies at reasonable prices among the remaining 90%. Buffett has previously stated that there will be 2 or 3 times in the next 20 to 30 years when it will rain gold. And all you have to do is go outside, but we're not sure when that will be. So, if you can't find any hidden gems in today's markets, and you've tried everything, perhaps you should keep some money on the sidelines and wait for that golden rain Buffett, who never lets a single percentage of return slip away, even when he can't find anything useful to do with his money. He realizes that having them in treasury bills is preferable to having them in cash. Treasury bills are short-term fixed-income investments that have maturities of 1 year or less. So they function similarly to cash, but with a lower yield. $111 billion. The previously mentioned $143 billion is invested here. At today's yield of 0.09 to 0.13%. This will not make anyone wealthy, but it is better than nothing. It is not unusual to overhear the world's best semester trash talk. Wall Street, and this year was no exception. I believe Wall Street has had it coming to them this year. Buffett disagrees with many active managers who have recently questioned index investing, claiming that it is no longer viable and that we are in the midst of an index fund bubble. He means that an index fund is a representation of the overall market in which it invests. And, as we discussed earlier in this video, he believes that one should never bet against America. Buffett believes that for the passive investor who does not want to or simply does not have time to analyze individual companies, this is the best option. The best way to invest is through index funds. You will reap the benefits of stock ownership at a very low cost. So why do many active managers on Wall Street believe there is an index fund bubble? It's possible that they believe in it, but it's also possible that they are losing business to index funds and will go to any length to prevent that from happening. Most actively managed funds on Wall Street, and elsewhere, are nothing more than a marketing ploy. According to Buffett, it pays the most to be a good salesperson and to perform exceptionally well when it comes to managing other people's money. However, the essence is in the selling pot, and performance is much more difficult to achieve as well. So, the basic fee structure of many actively managed funds is known as 2 and 20, which means that the managers are paid 2% of the fund's total assets each year regardless of how well it performs, plus an additional 20% of profits above a certain predefined benchmark. This benchmark is frequently the S&P 500. Buffett once asked a hedge fund manager how he could charge 2 and 20% for his fund, despite the fact that he had no proof that he could outperform an essentially free investment in an index fund. The manager replied, "Well, that's because I can't get 3 and 30. Buffett mentions a story about a woman, a friend of his, who asks where she should put a certain amount of money. He asks if she has any credit card debts, and she does, with an interest rate of about 18%. Buffett claims that before she can do anything else with the money, she must repay it, even though I would lend her money at those rates. Buffett claims, "I don't know how to get better returns anywhere else." So, before you even consider investing in the stock market, pay off all of your high-interest debt. That is the most certain return savings that you might be able to obtain.